Hello, everyone. Today on the Final Bar, I'm talking to David Auerbach. We'll talk about REITs. We'll talk about the real estate space. Just happens to be the number one sector out of 11 today. We'll talk about the overall trajectory, though, right? We have energy at the bottom of the list, the only one of the 11 S&P sectors down today as the S&P pushes right above 4,600, not looking back, closing around 4,630. At what point do we decide this is more of a bullish overall configuration? Ladies and gentlemen, this is the Final Bar. Hello, everyone, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market activity using the power of stock charts, using data visualization techniques to better understand investor behavior, investor psychology, market structure. We've talked in recent days, in recent weeks, even recent months about this overall rotation from a bullish phase in 2021 to more of a bearish structure that we've seen. We've seen that across the board in terms of breadth conditions, momentum conditions, all struggling a bit. But a lot of that's changed here in the last couple of weeks. You've seen a growth-led rally, and to even today, you have technology, the second from the top of the list, followed by communication services. So there's a growthy feel at times to this market. However, the challenge, as always, I would argue, is separating the short term, what's happening on a particular day, versus the long term. Remember, one day doesn't tell you a ton. A sequence of days, a trend that evolves over the course of multiple days, multiple trading sessions, is where you can really appreciate a change of course for the markets. We may have seen that here as we finally close above 4,600 on strength today. Of course, there's always a competing narrative, and here you go. We're entering the end of the quarter. It could be just a quarter-end rally before back to reality on Friday. We'll have to see. We have great guests on the show. I'm excited to talk to David Auerbach here in a few moments. The remainder of this week, on Wednesday the 30th, we have Mark Newton from Fundstrat Global Advisors. On Thursday the 31st, Tim Tashler from Sprott Global. Next week, on the 5th, we have Kathy Donnelly, author, trader, and educator. So a lot of great discussions to be had here on the Final Bar. I want to continue on with our market recap. Let's debrief on what's happened today from a technical perspective, but I want to start with a poll. We always have a poll going on our social media accounts, also on StockCharts.com/TV, and we asked you recently, know your technical indicators. Which of these would be considered a trailing stop indicator? Parabolic systems, RSI, DMI, or the ADX line? And 67% of you answered absolutely correct. Parabolic systems is indeed a trailing stop indicator. All four of these, by the way, are created by Wells Wilder. He wrote a book called New Concepts in Technical Trading Systems, I want to say. It was all in the 1970s as a way to try to understand short-term movements in commodities. And a lot of the modern technical indicator toolkit really was the foundation of that was built in Wells Wilder's spreadsheets, and you actually have the accounting ledgers, or like the columnar paths in his book, where he shows you how he hand calculated those indicators. Parabolic systems is an interesting one because it's designed to trail behind the price and recognize when the trend has shifted. Interesting time to be thinking about that kind of indicator now, as we're trying to lock in gains, recognize trend changes. That's what a trailing stop indicator is designed to capture. Continuing on here with our market recap, the S&P, as I mentioned, a pretty decent day here, chopping around for the first half of the day, but accelerating higher in the afternoon session. The S&P closing above 4630. The Nasdaq Composite up almost 2% today, 14,600 or so. Mid caps and small caps outperforming the S&P, with the small cap S&P 600 index about double the percent return of the S&P, up 2.4%. The VIX, by the way, continuing to push lower. We talked not too long ago about the VIX in the 30s, how that represents elevated volatility. While overall, the average volatility level has certainly been pretty high here in 2022, we're seeing the VIX come down and remain below 20 today, off just a bit below 19. Interest rates, kind of a choppy session in fixed income land, but the 10-year yield finishing the day right around 2.4%. Bond prices obviously moving higher. The dollar index actually a fairly weak day, down 0.6% using the UUP. Gold and silver ended the day flat, although gold opened a lot lower today. It felt like it was a real negative day for commodities. Overall, ended up sort of mixed with gold and silver right around the zero line. As I mentioned, energy was the only one of the 11 S&P sectors down today. Cryptocurrencies certainly have shown some renewed strength, and I put an article it was actually Friday, and it was really funny. I sent a screenshot to Julius DeKempeter. We'd done a webcast earlier in the week, and apparently we're on the total same page because within moments of each other, he's halfway across the world. We both put an article talking about Bitcoin and bullish structures, bullish evolution of some of those fairly commonly followed coins, the most liquid coins, Bitcoin, Ether, and others. And we had a similar sort of discussion talking about, consolidation range in both of those and rotating to the upside. Bitcoin and Ether both continuing to push to the upside. Bitcoin is actually traded around 48,000 a couple times here in the last 24 hours, currently just below that. But overall, nice rotation higher in a lot of cryptocurrencies here in the last couple sessions. Let's look at the daily chart of the S&P 500, just sort of reset on where we're at. Now, I've mentioned as we've bounced off of 4,200, every one of these points, I've highlighted these key levels, talked about what we would need to see, where we might expect resistance, and the S&P has met and eclipsed every single one of these levels. We first talked about trendline resistance, which was violated to the upside. We talked about the resistance, the highs from early March, which were broken to the upside. We talked about both of the moving averages, which were now broken above. And then finally, we talked about the last Fibonacci retracement level around 4550, the final February highs at 4600. As of today, we literally gapped above those levels. So here's how I would see this based on just the short-term dynamic. There's no way to deny that this is now an uptrend. And while I've called this a bear market rally, it feels less and less like that, particularly as you've seen improvements in momentum and improvements in breadth. And I think this week, we're really starting to finally see that. Two things that are really encouraging on the market in the short term, getting above 4,600, that last level of resistance, I would argue clears the way to all-time highs, and I think we might be headed back to 4,800. What would tell me I'm wrong is we get back below 4,600. Today was the breakout. Do we hold that gap? And actually, someone was asking me about gaps earlier today, and I was talking about breakaway gaps, continuation gaps, some of the different ones, and if what I just said does not make sense, make sure you hit the chart school section of StockCharts.com and brush up on gaps, increase your gap awareness. But that's basically when there's no overlap from one day's prices to the next day's prices, a whole set of tools to try to help you understand what that means. And often the upper end of a gap can serve as potential support. So 4,600, a really important level to be watching. As the momentum has improved and the RSI got above 60 over the last couple sessions, which suggests more of a bull market configuration than a bear market configuration. The good news is a lot of these growthy leadership stocks leading the last couple of weeks have had quite a bounce. And at some point you get a pullback there. The question is, do we get a higher low? And that could be a really interesting opportunity to layer in positions, riding the potential next move higher in this market. From a sector perspective, real estate, the number one sector out of the 11, up 2.9% today, as I mentioned, followed by some of the growthy stuff, technology, communication services, consumer discretionary. These are sort of the FANG sectors, all again showing real signs of strength during this period. Communication services is an interesting one. This has been by far one of the ugliest parts of the equity markets. If you look at the 11 S&P sectors, it is certainly a downside outlier, having rough performance. But look at the bounce on the XLC in the little preview chart there from 64 up to 70 just in the last couple weeks, getting above that late February high, which is certainly in the short term a sign of encouragement. On the downside, the laggards today, healthcare, financials, obviously usually a play on the yield curve, a play on rates. You have rates coming off a bit, and that's certainly causing some underperformance there. And the energy sector, which is usually a play on oil prices. Expectation headlines that perhaps the events in Europe and Ukraine and Russia are starting to, hopefully we're seeing a light at the end of the tunnel in some way, or at least we're getting some bullish headlines there, and that's causing energy prices to come off just a little bit there. We'll finish off today just looking briefly at the Mindful Investor live chart list. Let's talk about some of the key breadth measures, because breadth, one of the reasons why I've been less optimistic about this environment has been a lack of upside participation in breadth. And again, the price of the index tells you the overall trend. The breadth tells you the characteristics of the stocks that make up those indexes. What still concerns me, and again, I've learned to be naturally skeptical. Whatever the market's doing, I'm going to look for the opposite to try to play that. So when the market's selling up, I'm looking for signs, like for green shoots, for signs of optimism. When the market rallies, I'm looking for signs of weakness. One thing we've not seen in terms of confirmation are these cumulative advanced decline lines getting above their February highs. The S&P just closed above its February highs today, getting above 4,600. These breadth lines haven't quite done that. Now, these are not updated for today's close just yet. I would not be surprised, given the strength today, if the S&P AD line finally gets above the February highs. I'd be looking through the remainder of this week if you get further confirmation from some of these other breadth measures as well, because all of these are coming off of new lows, a couple of weeks ago, right? Finally, we'll talk about the percent of stocks above their moving averages. We now have 54% of the S&P above their 200-day. That is certainly encouraging. Remaining above 50%, I think, would be key. If you're bullish on this market and you think this is the beginning of the next leg higher to 5,000, you certainly want to make sure that this remains above 50%, because that tells you there are enough stocks also participating in the upside to provide that upside momentum for the indexes as a whole. We need to take a quick commercial break, and we'll be back with today's guest, David Auerbach. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close for our show. A couple quick announcements before we get to today's guest, David Auerbach. First off, we're going to do a mailbag segment right after my conversation with David. They're all featuring questions from viewers like you in the last couple days. Keep your questions coming. Our email is thefinalbar@StockCharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air in our next mailbag on Friday's show. Also, go to StockChartsTV.com. All of our content there is free. Fantastic, knowledgeable guests like David Auerbach and many others. Special events like The Pitch and our Market Outlook series, all featured on our website, StockChartsTV.com, or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, David Auerbach, joining on the show once again. He's a managing director at Armada ETF Advisors. David, good to see you and welcome back.
Dave, great to see you. Let me tell you once again, my favorite event is Friday night Keller Family Pizza Tour. So excited to be here with you. It's a shame it's not on Friday enjoying pizza together, though.
Always, always. We'll do it in person one of these days, David. But to start off with, REITs, obviously, and it's amazing how you scripted your appearance here with a nice rally in the real estate sector, the number one today out of 11. But we're seeing some emerging strength in some of these names. We're looking at Invitation Homes to start with. What are you seeing here?
Dave, single-family rental REITs have been on fire recently. There was a great story on 60 Minutes a couple of weeks ago talking about how we're in a 4 million home shortage to satisfy the demand for home ownership. As a result, the winning sectors include single-family rentals like Invitation Homes. Looking at their most recent investor presentation, they're talking about new leases of like 14.5% in February, renewals coming in at just under 10% rental rate growth. And they're basically at like 98% occupancy right now. And so they're pushing rent renewals, high rent increases, and almost fully occupied here. So we think this is just a really good, interesting story to be following.
And names like this have pulled back earlier in the year, but really starting to rotate higher with a lot of other ones. The second name you wanted to share with us, American Campus Communities, ACC.
Great story. This is the only traded student housing REIT. They basically own the properties that would be like right across the street from campus. So it's considered off-campus housing. They have luxury, call it luxury dorms, but like some of the top Power 5 schools, they're seeing enrollment levels that are back at pre-pandemic levels. They're close to 95, 96% occupancy and seeing like 3.5% or just under 4% rental growth. And so again, we're talking about full dorm students going back and knowing how those population trends continue to evolve. that enrollment trend is going to continue to go up, not go down, most likely.
It's a great chart, by the way, and a good, what strikes me with both of these charts we started with, David, just long-term uptrends, consistent up and to the right, but ACC, for example, making a new, or at least threatening a new 52-week high here. Your third name, CPT, Camden Property Trust.
So if you look at the winners during COVID, it happened to be some of the Sun Belt apartment REITs. Camden, based in Houston, Texas, they're basically at 96%, 97% occupancy, 16%, just under 16% in new lease rates, renewals coming in around 13%. These are markets where everybody's moving into right now. Atlanta, Austin, Dallas, Charlotte, Orlando, Phoenix, Raleigh. These are Tampa. These are just markets that, again, Zillow, Redfin are telling where people are relocating. And so they're just playing onto that strength, which leads to your fourth chart, the Home Appreciation US REIT ETF. We found a good opportunity here because with home ownership getting so much more difficult for folks to achieve that American home ownership dream, we put together a great ETF wrapper here to capture all these sectors that are benefiting from the population trends and property segments that are benefiting from it, such as single-family rentals, manufactured housing, and Sunbelt apartments.
It's congratulations, by the way, on the new ETF. That's fantastic, David. HAUS is the ticker, and we have it loaded on the StockCharts platform for those that want to bring it up. I feel like if we have time for a question or two, David, a lot of the headlines we've been looking at recently talk about mortgage rates obviously going higher, interest rates going higher, mortgage rates going higher. Something like that, sort of a macro, change in the environment. How does that impact how you're thinking about not just these ones that you've shared, but just generally the real estate space?
First of all, for any time I get a question like this, my first response is always to direct the listener or the reader to go to REIT.com. That's the National Association of Real Estate Investment Trusts. Excuse me. They have a wealth of data that talks about how REITs in general tend to outperform in rising interest rate and inflation environments. When you look at the long-term big picture, that's the key here. For a lot of these guys have rent agreements or lease agreements in place with rent escalator clauses tied to inflation rates or built-in, escalators as they call it. And so in a big picture, the end tenant, like the apartment user, let's say, doesn't care that mortgage rates are going up necessarily. The interest rate hike really affects more of the construction loan side, the developer side of things. But in the grand scheme of things, with mortgage rates going up and home prices going higher, it is shutting out more and more people from the housing market. So we're just trying to approach it from the most conducive way to potentially play that housing crisis.
David, it's awesome to see you. Congrats again on the new ETF. Wish you well, and stay safe there. We'll talk to you again soon.
Thanks, David. Appreciate it. Take care.
That's David Auerbach. David's a managing director at Armada ETF Advisors. Recently released their new Home Appreciation US REIT ETF, ticker HAUS. And I love that last question. I find it's a pleasure to have guys like David who are really knowledgeable in their particular areas of focus. I've seen a lot of headlines about obviously home ownership changes. Just in Seattle, which is our area, just the market that's gone crazy, which I know with a lot of other cities as well, and it's a challenging environment to try to understand the relationship between some of these moving parts. Great take there by David Auerbach on this appreciation in the real estate sector and a couple of particular ideas for all of us. Thanks again to David Auerbach. Let's continue on with our next segment today, the Final Bar Mailbag. As a reminder, we are here for your questions at all times. The Final Bar at StockCharts.com is our email, and let's get to question number one. My worry with the recent rally is the lack of volume. Looking at the daily SPY and the QQQ, for instance, the volume trend looks down. What do we make of that? Really good question, and the short answer is you're absolutely right. You'll notice I have volume featured on almost none of my charts, and I apologize for that. I may be doing volume a disservice by doing that, but to be honest with you, earlier on in my career, as I was learning the discipline of technical analysis, I used volume on everything because you were taught there is a relationship between price and volume, particularly with price patterns, things like a head and shoulders pattern or a triangle pattern. John Murphy's books on the topic and others as well talk about the volume characteristics. And really, if you don't see the proper volume signals, the pattern is not valid. The pattern is not validated. So, but at some point in the last 20 odd years, I've gotten away from it. I think part of it is just the structural changes in the market. volume means something a little different now than it did 50 years ago, for sure, in terms of what it represents, right? Just in terms of where stocks are traded, how they're traded. It used to be on a floor of in a pit, at a post or something where it was literally a linear track of price and trading volume that you could track. That's all different now. However, recognizing that the market is going higher on less and less volume is certainly something I would be paying attention to. And you're absolutely right. The rally that we've seen here over the last couple of weeks, two areas of concern I would say have been a lack of confirmation from breadth and a lack of confirmation from volume. Both of those speak to less of a meaningful backing to that move. And if you look at a lot of volume reads, you'll see a spike a couple weeks ago from quad witching day, or in the last couple weeks from that quad witching day. Was that Friday with a ton of volume, sort of artificial volume because of options expiration. Other than that, the trend overall has been fairly negative. Now, I will tell you, there are plenty of times in recent market history where the market moves higher and it continues even though there's been less volume. But you're absolutely right. I think of it as one data point among many, and you're absolutely right. It does not really confirm this upswing, this growth-led rally that we've been seeing in the markets. Next question. For the past couple days, I watched SPY bumping to the top of the Bollinger Bands. I would expect a bit of a pullback, which came Wednesday. I think you were talking about Wednesday of last week. It seemed overdue, yet on the final bar, most of the charts we looked at were to confirm your belief that the worst hasn't been seen yet. Your confirmation bias seems high. Cold words here from the final bar mailbag, but you are absolutely right. Listen, I will tell you, I have studied behavioral biases. I have taught them at the college level in depth with a lot of students and many investment professionals. That does not mean for a moment that I am immune to some of their problems. So you're absolutely right. Having said that, no, I would tend to think of the markets. I tend to think of it in terms of your overall bias based on the weight of the evidence. Having said that, I would argue that the weight of the evidence has been fairly negative, and then this rally that we've seen has started to unwind that. And at some point, you have to recognize that the evidence has changed. If I would remain bearish as the market continues to push higher and higher, then I think you could absolutely say that certainly seems like some sort of confirmation bias. Now, what I'm trying to do is just bring up the Bollinger Bands. I don't bring up a lot of Bollinger Bands on the show, so I just wanted to show everyone what the Bollinger Bands look like. So the Bollinger Bands are basically an exercise in really in mean reversion, but it's about standard deviations around a mean. You start with a moving average, so we're starting with a 20-day, and most people use the 20 or 21-day simple moving average in the middle, and then you're looking at two standard deviations above and below that moving average. So when the price moves away from the midpoint, the bands on both sides actually break away from the price. They push away. So the more volatile the market, the wider the bands get. So that's actually why Bollinger Bandwidth, which we have as a separate indicator, can be a good way of tracking overall volatility, just in terms of deviation from the average price. Having said that, you're right. The price is doing what's known as riding the upper band. You can see a similar movement in October of last year, where you actually had this run through the upper bands. We pulled back a bit, but overall continuing over the next month or two into the eventual all-time high late December, early January. So while Bollinger Bands are not one of the main indicators that I use in my toolkit, I will tell you at times in my career it's been very, very helpful. And when you break below the lower band or break above the upper band, often that can tell you there's a significant momentum in that direction, and you want to see if there's follow through to the upside. So you're absolutely right. I mean, the significance, the strength of this rally out of the lows, I think was surprising to many of us. At some point, you have to recognize that the trend has changed. That's why we try to track some of those levels in the middle. My market trend model, by the way, my medium-term model on Friday did not turn positive just yet. Most likely this Friday would do so, barring some huge sell-off in stocks. Next question. I liked your commentary, but noticed the bearish divergence in RSI 14 that was on your UNH chart. This always sticks out to me as I started with RSI 14, so I'm wondering if it's meaningful to you or why not so much. You're looking at this chart, I would guess, and you're saying UNH moving higher. So I think what's happening here is actually you're talking about a bearish divergence in RSI, and I think you're talking about this back here, maybe here, right, where you have price moving higher and you have the RSI moving lower. So this isn't my favorite example of a bearish momentum divergence. The chart I shared yesterday on the XLE might be a better example of that, where you have on a closing basis higher closes over the last couple of weeks and a clear divergence. Something like a momentum divergence, there are really clear textbook examples I think the XLE right now is one of those. I think the bullish divergence you had September, October of 2020 is a good, pretty classic example of a bullish momentum divergence. I don't know if that's particularly clear right now in the UNH, although I think what you're talking about is overbought here and not overbought here as we're making new all-time highs. I totally get it. Bearish divergences are a leading indicator that tells you that the market is moving higher, which is good, but on less momentum, which is a bit of a warning sign. It's kind of like the market moving higher on weaker volume or weaker momentum of any sort of measurement. For me, this is a leading indicator. I would be looking for validation from some lagging indicators to actually get the downside follow through on something like UNH. That's why, for the moment, it doesn't concern me a ton relative to other inputs. Next question. I heard someone talking about growth getting oversold by, quote, 2 sigmas, which I believe means by 2 standard deviations. This is a term I feel I should have a better grasp on, but can you help me? I try to watch and understand the average true range because I use parabolic SAR to identify theoretical places to set stops. Yeah, so one of the things I don't really enjoy about the financial industry is the goal of using language which confuses as opposed to language which clarifies or simplifies. That's my goal on this show, is to take things that are confusing and make them less confusing. 2 sigmas indeed does mean 2 standard deviations, and it basically comes from statistics, right? Sigma is basically 1 standard deviation or a measure of deviation, measure of volatility, and that's the simple mathematical way of describing that. So yeah, 2 sigma move. If you remember back to like your statistics, if I want to remember right, I think 2 standard deviations is 95%. So if you have a bell curve, sort of a standard distribution, then 2 standard deviations means within 95% of the observations, which means you have 5% that are outside of those standard deviations. What's interesting is if you think about it, if you ever heard of like a 5 sigma move or a 5 standard deviation move, that's sort of like a huge unlikely scenario, something that's so unlikely, like getting struck by lightning. It's probably ridiculous to think about. The reality in equities is you actually have what are called fat tails. Those really, black swan events. If you know your market literature, look up that book, which talks about these very unlikely but possible events. They happen way more often in finance than you would expect given a normal distribution. So I would point you there to learn more about standard deviations and why the markets actually have fat tail distributions. We need to wrap the show. Go to the 3 in 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the Nasdaq Composite. We shared this chart, I think, last week, and we talked about the longer-term trend in the Nasdaq Composite. You see this resistance level just above 14,000. This was resistance a number of times in 2021, became support a number of times in later 2021, again has become resistance. We've now broken above that to the upside. We're very close to the 200-day moving average. The Nasdaq today breaking above its February highs. This is one of those levels and one of those breakouts that I'd said, until we see that, it's hard to be too comfortable with a bull market phase. We're seeing that today. Assuming you get further follow through the remainder of this week, this is a market structurally getting more and more to a positive and more of a bullish configuration. Chart number 2, advancers, decliners. Yesterday and the day before, when we talk about a lack of volume, a lack of breadth, you had less than 50% of the New York Stock Exchange members closing higher on the day. So even though the S&P was closing higher, most stocks, or over half of stocks, were actually not doing so. Yesterday in particular was a great example of that. Today, not doing so, right? You actually get the market moving higher with most stocks. 4 out of 5 names by the reading I'm looking at here closing higher today, which is a pretty encouraging breadth reading. A lack of breadth has been concerning. Confirmation with breadth, which we're actually seeing it a little bit on today's session, is a little more encouraging. Finally, we'll leave it with real estate. I had a great conversation earlier with David Auerbach. We're talking about a number of residential REITs and what that might mean. I just want to highlight the overall real estate sector making a nice rotation from lower lows to higher lows, from lower highs to higher highs. The real estate sector has now regained moving averages and making a new swing high. Further strength in a chart like this suggests further strength going forward. Folks, that is our show for today. I want to thank you so much for joining us every weekday after the close. Special thank you to David Auerbach sharing his perspective on real estate. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.